to the Roskill people. This is a series of talks, and they'll be running on the last Friday of every second month, obviously starting today. So our speaker today, who's going to kick off the series, is Neal Brewster. He joined Roskill in 2019, and he's responsible for the development, coordination, and production of economic and financial analysis at Roskill, and leads or advises on strategic consulting projects. He's got experience of macroeconomic and microeconomic analysis and a wide range of metals, minerals, and energy markets, as well as the development and application of advanced financial modeling techniques. He previously ran his own independent consulting company, and before that, he worked with Rio Tinto, and before that, as a government economic advisor. Before I hand over to Neal, if I could just ask everybody to please switch off your mics and your videos, except you, Neal. It just saves on bandwidth, and it helps the speaker not get distracted. And with that, I'm handing over to Neal. Thanks so much.
Thanks, Nalina. It's great to be here. So hello from Roskill. So in terms of today's agenda, so just a little disclaimer about forward-looking statements. I'm going to sort of introduce Roskill and then talk about macroeconomic trends and commodity market issues. And then I'm going to be joined by my colleagues, Jack and John, to have a panel discussion based on sort of Q&A coming into us. Just to say, this is the first of sort of six lunchtime talks that Roskill are giving with the GSSA. Mine's focused on macro trends. The other's focusing much more on individual commodity market issues and sustainability type issues as well. So these will be coming up over the next sort of 3 to 4 months. In terms of Roskill, we're the leader in critical materials supply chain intelligence analysis. We do this through reports, our consulting business, delivering analysis on sustainability and costs. And also we run an events program. We operate around the world, formed in 1930, and we opened our office in Cape Town about a year ago, actually just over a year ago. But we have offices in Europe, North America, and Australasia as well. In terms of our commodity coverage, we're sort of focused on 4 divisions: battery and EV materials, steel alloys, what we call technology metals, and then strategic minerals. These cover sort of 30 to 40 commodities, and sort of really focus on a lot of the kind of more minor metals, critical raw materials that other firms don't really cover to the same degree. But we also cover, you know, copper and steel markets as part of that kind of broader reach. Our sort of, you know, key reports are 30 annual reports covering 10-year outlooks for those 30 commodities, which you can buy for sort of up to 5 users. We do quarterly updates in these in terms of supply-demand outlooks, and all the data summary packs are available to sort of clients, as well as access to our individual analyst team. And just to say, in terms of events, it's also been a quiet year for events for us as everybody else. We've done quite a lot of online webinars that last year. But next year, so February next year, we'll be hosting a steel alloys conference in Johannesburg. So do get in touch with us if you want to be part of that conference. I think there's a discount available to kind of GSSA members. So do email Jack or the events team, available on our website if you're interested in attending that in under a year's time. Okay, so jumping into the sort of slide deck now, really starting with sort of inevitably sort of COVID, you know, deaths and cases. And I guess as a macro forecaster, now you kind of start always with your sort of COVID slide. I guess what we have seen over the last 12 months is economies have got better at managing under COVID restrictions. So initially we had very severe impacts on economies from lockdowns. Over time, economies have got better at dealing with those restrictions in terms of maintaining output at improved levels. But clearly there are ongoing restrictions in a large number of economies, particularly at the moment in sort of Europe, but also, you know, in other countries as well. That is leading to ongoing constraints on economic output. In terms of sort of, you know, cases and deaths, you know, we've been sort of 2 waves globally of sort of cases and deaths. They were falling or started to fall start this year, but we have seen some sort of pickup in cases in Europe in the last couple of months, and that again is leading to kind of new sort of restrictions in terms of the economies. The expectation though is that as we go through the course of 2021, COVID will get under better control, and the economies can be released more and more, and that will lead to improvements in economic output. And that is indeed what we're assuming in our sort of base case forecast for the world economy, and that feeds through into our outlook for various metals markets. Now, I guess underpinning that is sort of vaccination programs around the world. On the right-hand side here, what I'll put is sort of a chart of sort of vaccination rates in some of the sort of major economies. The sort of green line here shows kind of, latest levels of vaccination rates. And you see sort of a split there, sort of, Israel, pretty much fully vaccinated, in the UK, in the US, and some other countries such as Chile, half populations have been vaccinated. But then when you look at the rest of Europe and more developing economies, you still see quite a lagging number of sort of vaccinations that have taken place to date. Now, looking forward, what I've done here basically is take the last month's vaccination rate and sort of roll that forward month by month to kind of see where it takes us. Now, it's obviously quite a dynamic picture, and things will change over time. What that kind of says, though, is that by the end of the sort of second quarter, pretty much, that first group of countries should be fully vaccinated. But in Europe, vaccinations will only be about half of the populations, and the rest of the world really just sort of early stages of that development. By the end of the year, even by then, at current rates of vaccination, large parts of Europe won't be fully vaccinated. And in terms of sort of developing countries, and even sort of Japan, South Africa's in there as well, really quite far behind that development. Now these programs should pick up over the course of the year. Hopefully these kind of bars will sort of go out more than we forecast here, or project here. These aren't kind of forecasts, they're more projections based on recent trends. But I want to highlight that whilst the our view and the sort of view in the market is that vaccinations will be delivered, economies will open up, that's not a given. And of course, the big concern about vaccinations is will they work? And of course, yes, they do work, but with new variants, that effectiveness might not be as good, and that require booster jabs down the track. So clearly, that does lead to sort of risk and uncertainty on our outlook based upon COVID and its development over the course of the year. In terms of sort of what is meant for the economies, this slide here shows what industrial production and trade, and on the right hand side some leading indicators. So when we had the first lockdowns, we saw falls in industrial production, first in China, so 13% fall in industrial production in China in February, and then that spread around the world. We saw falls in industrial production of 16% in the US, in Europe even bigger, so 28% falls in at that point in time. Now, over the course of the year, as economies got better at dealing with COVID, and over the summer period where we saw economies opening up, we did see a very strong bounce back in industrial production, and led by China, but then also in the US and the kind of Eurozone as well. So that has meant that over last year, we saw globally a fall in industrial production about 6%, but as of sort of January, February, IP in China was up by about 3 to 4% year on year. US had pretty much recovered, as had Europe in terms of industrial production levels. And going forward, leading indicators say that growth will continue, but at a slower pace. And again, that is contingent upon that story around injections and COVID and restrictions easing over time. So that's sort of industrial production. Looking at GDP, this again highlights an index of GDP in some major economies. And again, we see those kind of very big falls in Q2 last year. So GDP fell by, in sort of major economies, from somewhere between sort of 9% to kind of 20%, depending on where you were. The UK was quite hardly hit. The US less so, really depending upon the nature of their economies, in terms of sort of dependent on services and trade and sort of regulation around COVID, really about population densities and factors like that. So last year globally, GDP fell by about 3.7%, and that's a sort of a sort of unprecedented fall in GDP since really kind of World War II or even beyond that. The view this year, our view is there will be a strong rebound in GDP for reasons already outlined. I think supporting that are, factors such as very high levels of savings accumulated over the last 12 months. In the UK, for example, savings rates hit 25%, and that spending we think will come back and will supercharge the recovery. On top of that, government spending is sort of taking off. The well-publicized Biden package, that's $1.9 trillion of spending going into this economy over the next 1 to 2 years. Low interest rates, also spending in Europe. So for example, the kind of green recovery program there. So these all talk to a very strong rebound in GDP globally this year. This is our forecast from the start of this year. So we have a rise of world GDP about 5.2%, but it could be even higher than that. These numbers will be updated in the coming weeks. So, globally, it's going to be a strong recovery is expected, and possibly too strong. And I think, the key concern is this amount of spending and stimulus could well be too much given the capacity limits of the economy, and we could start to see inflation picking up, and that might trigger a round of interest rate rises, and that brings to kind of see how that affects kind of investment patterns and what happens after that. I guess the one note of caution about that outlook, though, is probably around China, headline growth for China this year will probably be a rise of 8% in GDP year on year. But of course, that sort of masks an increase over low levels of output in the first half of last year. When you look at the quarterly trend in Chinese GDP, it's more likely to be growth of sort of 5 to 6% quarter on quarter, annualized quarter on quarter growth, which is sort of much less than we've seen in China over the last 12 months. Now, underpinning that, I guess, is sort of an underlying view of the Chinese economy, where it is transitioning from a sort of period of kind of very high growth focused on fixed investment to one where it's going to be more driven by internal consumption and economy rebalances away from investment. And that talks to sort of lower underlying growth in the Chinese economy, but a more sort of consumption-led growth pattern as well. And the Chinese government is sort of encouraging this for its kind of recent 5-year plan, focusing much less on growth targets and much about the quality of growth in China's economy. Now, what that does mean is that growth will probably be less intensive in terms of metals demand than we've seen in recent times. And that's an ongoing evolution, but it's one that sort of is being sped up by sort of government reforms and changes. And that's important thinking about the next 5 to 10 year outlook in terms of the markets where we're kind of primarily interested in sort of analysing in terms of commodity markets. Just in terms of sort of South Africa briefly, this shows South African industrial production leading indicator on the left-hand side. South Africa was really quite badly hit by COVID. So, over 50,000 deaths, 1.5 million COVID cases of COVID in the country, which is sort of relatively high actually, for sort of a developing country, and is really comparable to sort of parts of Europe as well. And that led to sort of, really quite, tremendous falls in industrial production of up to 50% early in the year. The bounce back has been very strong though, and industrial production year on year is back to kind of where it was pre-COVID levels. Going forward though, in our forecast, and this realigns also against views by the IMF, OECD, etc., we have quite modest growth in the economy this year. So last year, South Africa GDP fell by about 7 to 8% year on year. This year growth we have is only about 3% year on year, which is much smaller recovery in GDP than we sort of are forecasting in other parts of the world. I guess underlying this is really sort of structural constraints in the Chinese, in the South African economy around just capacity for growth and productivity, just the efficiency of kind of government. And also less scope for fiscal stimulus in South Africa because of sort of rising deficits over time. So just less of a growth dynamic that really feeds into that kind of outlook. I guess in terms of exchange rates, we saw a big fall off in the rand as we saw in other commodity exporting exchange rates as well earlier in the year. But it was a bigger fall, and that reflected, I guess, also those issues around South African exports and sort of more severe impacts on the economy of those sort of COVID restrictions in terms of ability to sort of produce and kind of trade. This trade rate has rebounded pretty strongly, but not as much as for South Africa, for Chile, for example, and in case of the sort of Canadian exchange rate as well. So turning a bit more to sort of metals markets, I guess what sort of different about the sort of recent events is that you know, when GDP falls, we normally see sort of magnified effects in terms of metals demand around the world, and that reflects sort of sensitivity of industrial production to sort of growth and stocking and destocking trends. This time around, we've seen the opposite effect, so a much less geared effect in terms of metals demand, you know, over the last 12 months than we would expect given falls in GDP. So, for example, you know, during the financial crisis, crude steel production globally fell by 7.5%. Last year, it fell globally by you know, only sort of 1%. And the chart in the middle here shows some sort of falls in metals demand for some sort of important metals this time around compared to that previous financial crisis period. Right-hand side reflects that in terms of what it means for some mining stocks. There are really kind of 5 reasons for this. The first really is that sort of China is now, you know, accounts for half of metals demand. China bounced back quite quickly. Second reason is that a lot of that fall in GDP was really focused on services and usually rather than sort of goods output, which has held up much stronger, much more strong than we saw previously. And then there are kind of trends such as sort of working from home, you know, rising savings, and that's led to kind of relatively buoyant housing markets in North America and in Europe. A couple of reasons, I guess, as well. You know, fourthly, you know, demand was already weak in 2019, so in a sense we were off a low base in terms of demand. There's less scope for falling demand last year because you know markets had already been destocking in 2019. And lastly, we are seeing some sort of sectorial shifts in demand. Now, in particular, a shift to electric vehicles, so widely publicized, you know, by a lot of people. What it has meant is that you know, EV sales increased last year globally despite the financial crisis, and in things like nickel sulfate, we saw demand rise by 10% year on year, and that sort of sectorial drivers are clearly important in terms of some sort of markets and drive their own dynamic in terms of sort of demand and therefore pricing over and above sort of macro trends that sort of generally kind of most people focus on. This slide here shows a bit more detail in terms of what that's meant for sort of various raw materials prices. Now, so early in the crisis, you know, things like the gold price clearly responded very early. So gold, you know, went towards $2,000 per ounce, driven by cuts in interest rates, you know, driven by kind of fear factors. In that initial period elsewhere, you know, we saw sort of, you know, significant sell-offs in terms of metals prices. Oils obviously had its own issues there about sort of demand linked to sort of you know, aviation and transportation, clearly sort of very distinctive demand drivers there. And also oil had issues around OPEC plus supply going up because of a bit of a spat between Russia and Saudi Arabia during that kind of period. But we did see sort of falls in metals prices. They were moderated by supply reductions, but effectively they have bounced back quite quickly, and really accelerated over the course of last year, particularly in sort of Q3, and you know, increases in the first quarter of this year, where volatility in the last month or so. When you break that down, it's quite interesting to look at the composition of those trends, which I do on the left-hand side here. So commodities such as lithium carbonate, cobalt, rare earths, nickel sulfate mentioned before, they're the commodities that have seen the biggest rises in sort of price of those sort of critical raw materials. And again, that's been driven by, you know, this underpinning of sort of their demand sectors. This electrification of the world economy, EV vehicles have led to them being sort of accelerating in terms of that kind of pattern. I guess also some of those products were in oversupply prior to that for sort of 2 to 3 years. So we had a bit of a sort of a surge of investment in lithium, for example, that took place on the back of sort of the EV story, and really got ahead of the curve. The last year has really seen a tightening of those markets in terms of supply demand balances, and that's been enough to kind of engineer this recovery in prices. We look at the rest of the sort of complex here. Steel alloys have performed relatively well, but have lagged those other commodities. Iron ore's been a bit of an outlier in terms of that regard, in terms of other steel raw materials. What is lagging are these sort of technology metals, things like rhenium, tantalum, titanium. Now, a lot of these are linked to sort of aviation, for example, and aviation is clearly having its own sort of issues about what's happening in that market. Big falls in sort of deliveries by Airbus and by Boeing, and that's left their own sort of dynamic around sort of price outcomes. So I think I'd say the underlying story is sort of positive across the complex, but you need to dig into each sort of market in terms of its individual supply demand issues to understand the kind of price performance, and then sort of forthcoming Roskill lectures or talks, we'll dig into each of those to some degree, in turn talk about the individual sort of dynamics in terms of what's been happening, how that feeds into their outlook going forward as well. This slide here shows our sort of what we call our sort of price radar, and really reflects that kind of previous slide again in a slightly different way, and it shows the cycle around prices. So what's been sort of rising, what's been peaking, and what might follow on that. And again, looking at sort of iron ore, copper's up there. They've really had sort of quite good price performance, and indeed for lots of those products, spot prices now are kind of way above what we think will be their kind of long-term price outcome. But the question, of course, is how long will it stay at those levels? So will we have a period of extended oversupply, so extended high prices? Will that last for sort of 2, 3, 4, or even more years, or kind of will they fall quite quickly as the economy goes back to a normal kind of plane? And again, that's China's an important part of that analysis, as well as those end-use market trends. So just to kind of finish up in time available, I think beyond those sort of very specific sort of supply-demand issues, I think the pandemic will have some lasting impacts for the world economy and metals markets. And some of these are political. We're seeing changes in political leadership, most notably in the US, but also effects on international relationships, which have been under stress. We see it in Europe, particularly in the UK, of course, with kind of Brexit overriding or on top of all those issues, but also there's tensions between China and the rest of the world. And that's really important in terms of what that means going forward in terms of trade and flow of commodities around the world. I think, what we are seeing is sort of an increased role of the state in the last 12 months, and that seems to be here to stay for a while. So more sort of demand management by governments, more kind of spending, not worried about taxes, and that's sort of positive for the growth in the near term. That does imply overhanging debts in the world economy, non-performing loans in large parts of the business area as well. And how those kind of play out might lead to sort of consequences down the track. So there might be some sort of some reverberation, I think, over sort of years to come, particularly as interest rates go up. We kind of find out who's not been wearing trunks, where those debts lie, and what that means for sort of investment and sort of demand within the economy. And inflation is a really important part of that story as well. So if we do see that money being spent, leading to kind of higher demand, pick up in prices might accelerate that sort of rise in interest rates and cause that sort of downward cycle to kind of happen more kind of quickly. This is more sort of micro trends. Lots of stuff here, and I won't go into any detail now, but a big focus on inequality, social justice. People much more aware of the environment than they were a year ago. I live in West London, and sort of the lack of planes is a big change in terms of how we sort of see the world around us in terms of sort of airline noise and traffic. And a lot of that government spending is going to be on that sort of ESG and sort of green agenda. and that will lead to differences in sort of demand patterns for kind of many kind of metals. I think the other thing I would sort of highlight in terms of commodity markets is sort of some degree projects were halted during the sort of pandemic. If it does lead to kind of a disruption to commodity supply and investment, again, that might hold back, supply for a couple of years. So during the financial crisis, firms sort of gave up or abandoned projects. The effect of that in 2010, 2011 was a sort of supercharged bounce back in prices because supply had gone away in the market. And to what degree that's true in mining this time around, I guess we'll wait and see what happens there. And then issues around sort of supply chains, and again, those issues around the economy, electrification, working from home, airline travel, tech consolidation, e-commerce, all those are quite important factors to unpick. And at Roscoe, we're doing work around those, sort of really underpin our sort of forecasts for commodity demand over the next 10 years. And that will be ongoing work in progress over the next year and probably beyond that as well. So I'm going to stop there. That's my sort of bit of a rapid run through, but just as an overview in terms of our sort of view on the world economy, which trends in metals markets, and some sort of pointers around what that means and issues to think about going forward over the next year, and really beyond that as well. So at that point, Nalin, I'll perhaps hand back to you for a bit of a panel discussion.
Thanks so much for that. So there we go. That is our panel. And they will answer any questions and elaborate on the talk, which was fantastic. Thanks, Neal. You can either raise your hand or just jump right in and ask your questions.
Can I start off with one?
Absolutely, Craig, please do.
I was a little bit surprised to see the lag in price increases in the so-called tech metals. And I kind of would have expected to see that up there with the battery and EV stuff and the others. Specifically with COVID, I mean, is there evidence that we're driving tech a little bit harder? And is there liable to be a lag effect? Will those price increases come through in the next year or so, do you think?
Yeah, so I think, I mean, obviously I have comments as well, and I know because bringing John in terms of copper as well, but in terms of the broader picture there, it depends what you're looking at. So the ones that were already factors were things like rhenium, like titanium, and those are very heavily dependent upon the aerospace sector. And aerospace has just been sort of completely sort of kiboshed in terms of demand. So deliveries fell by more than half last year. I think Boeing had its lowest aircraft deliveries since sort of 1978 or something. Record falls. So I think for those, we have seen sort of really quite poor performance. I think that said, I mean, tin's done much better than those, and copper's got its own story as well. So I think it really is about those sort of, really is about the particular metals and energy markets. Going forward for those ones I mentioned, look, I think they'll sort of catch up. I think for airline, those we're really talking about probably a sort of a 3-year recovery in the airline sector. So those might take some while to kind of recover. But of course, once you get restocking taking place, that can perhaps make that happen a bit quicker in terms of price performance. But John, I mean, did you want to talk about copper more specifically in terms of tech metals?
Yeah, I mean, it's copper's obviously used in everything. So its label as a technology metal is slightly misleading, but some segments actually got hit very badly. So automotive wiring harness demand basically collapsed last year. Also, building wire demand was quite badly affected, particularly on the commercial side. But actually, some areas were quite good. I mean, we saw quite strong rebound in China, really across a number of different areas, but particularly in terms of wind power investment, to a certain extent in connecting these new wind farms into the grid. And latterly in the year, we saw quite a good bounce back in winding wire demand that really goes into motors, which are in almost everything, vehicles, white goods, and air conditioners. So yeah, the picture in copper is quite a mixed one. Some sectors doing quite well, but you have to remember that building wire and automotive wire is quite probably those two segments together are a third of total copper demand globally. So you've got some segments which have been quite badly hit, but other areas which are doing quite well.
Happy, Craig?
Yeah, sorry, I was just going to say I've very little to add on this subject, but I suppose if we remember Neal's graph that showed the tech metals doing comparatively poorly, I suppose the other thing to point out on the scale of that graph is just how surprisingly well perhaps some metals and minerals like lithium, cobalt, and nickel have done last year. The electric vehicles and the raw materials that underpin lithium ion have really weathered that economic storm brought about by COVID-19. So perhaps it sort of disproportionately sets that picture of the graph up. So it's not only tech metals doing badly, but certain metals really outperforming given the sort of prevailing macroeconomic conditions.
Craig, has that answered your question enough?
Yeah, pretty much. It gives one food for thought. Maybe I can throw in an investment type question. I mean, if you had to invest X amount of money in some sort of resource shares anywhere in the world, what would your top 3 picks be at this point in time? Or is that an unfair question?
Well, by no means will we give investment advice, but if we talk about the markets more generally, I think it would be sensible to look at some of the areas that are probably associated with the new sustainability agenda, with renewables, with the move towards a broader focus on ESG factors that Neal sort of touched on earlier. So raw material markets like lithium, like cobalt, nickel sulfate, things like rare earth, sort of powering that battery story. Copper, as John says, associated with everything, but also a very important part of the new energy transition. So I think it's not an unpopular opinion to think that some of those markets and therefore some of the equities that you could look to invest in within those markets might see positive returns over the next little while.
Yeah, I guess just to add to that, I mean, I think, it felt a year ago a bit of a no-brainer in terms of the sell-off, in terms of the mining stocks. I mean, they always get hit really early on because people sort of, it's an easy sell to short mining stocks if something bad happens. And they felt undervalued. I think, where they were in terms of the big miners, a month ago was sort of felt quite toppy on the other side, I guess, that was sort of the iron ore story there. So I think, and they have sold off in the last couple of weeks quite heavily, actually. I think, it's the hardest thing. I think it's always the quality of the individual asset opportunity, I think, to my mind. And I think, clearly in those EV space, there is demand for kind of new supply. Really finding good quality projects to invest in is always the key there. So I think, again, the quality of individual asset opportunity is always the main thing that you can really focus on. I think where we are now in terms of prices, things are kind of more fairly priced, and therefore it's less obvious. It's more difficult now to kind of pick individual sort of, to kind of sort of pick the sector within that, looking at individual assets that are those growth markets that have good prospects of being developed, in the next 2 to 3 years would be a good thing to focus on, I think.
Yeah, I'd add to that. Rare earths looks very interesting area, and obviously very constricted supply, but quite an encouraging demand outlook.
Okay, so maybe just if we could continue with that thought. So what do you think the impact of COVID will be on South Africa's mining and processing sector specifically?
It could be a good Jack question, I think.
Yeah, difficult. I mean, my understanding of the sort of rhetoric from South African policymakers and sort of industry leaders is that mine, smelter, refinery closures are going to be a last resort in the future. I don't think the economy was really prepared for another shutdown on the scale that we saw last year. So with that in mind, I think it's quite likely that output's not going to be too affected in 2021 by COVID-19 directly. Of course, extractive and processing operations don't exist in a vacuum. Last year, I think lots of the issues around South Africa were more associated with logistical shutdowns. There were, port issues. There were some strikes as well, and these affected not just the movement of materials produced in South Africa, but, for example, the copper and cobalt leaving the Congo and things like that as well. So COVID-19 further shutdowns, further tensions caused could impact the extractive sector, I think, indirectly, if not directly. But assuming that mining and processing continues, that's obviously good news for the economy. I think that's expected. I think that's priced in. Even though it's priced in, as Neal mentioned, I think consensus is just sort of about 3 to 4% growth this year. So maybe not fantastic with the kind of bounce back expected in other parts of the world. I think forecasts are a little bit mixed. Some probably quietly optimistic about the fortunes of the sector and the economy, and others pretty worried about the structural weaknesses that endure, the slow pace of the vaccination program, issues that endured before, like Eskom and labor markets. So I think for the mining sector itself, it's probably all okay, but the wider economy might see challenges. At the moment where we are in the UK, the rhetoric around foreign variants of COVID, for example, the South African variant is quite acute. I think if things like that carry on, it could have a detrimental effect on other parts of the South African economy in the long term, things like tourism, if this sort of rhetoric is enduring towards your next summer and holiday periods. So I think it's a sort of mixed bag. I don't think COVID will affect the mining sector directly, but the indirect impacts could have quite a long tail.
I think one thing to add to that is probably the issue around sort of focus on ESG type issues, supply chain robustness. And I guess we did see sort of, problems in Africa and South Africa in terms of sort of getting, product out of the country. And that does make customers question their sort of security of supply type issues. And I guess the challenge for sort of South Africa and rest of Africa is really about sort of, in that context, how can you address those issues that give customers faith about the provenance of what they're receiving, that it is sort of produced, fairly effectively, carbon footprint is kind of minimized. And those are sort of, those factors probably have been accelerated in the last year, but they aren't new issues, but they're being sort of picked up and sort of sped up. And I guess in that context, the challenge for sort of South Africa is really to address some of those issues, I think, going forward, as it is in other parts of the world as well, but particularly in Africa.
Thanks, Neal and Jack. John, you want to add anything to that? Don't want to leave you out.
My colleagues have covered that exhaustively, I think.
Are there any other questions you'd like to raise? Anybody, not just Jonathan?
I think Greg has his hand up.
Yeah, hi, thank you. Not really a COVID-related question, but I was just intrigued by a comment that was made by Neal on China. So, we've got China still looking to grow at kind of 5-6%, albeit at a lower level than it has grown before, which is still, I guess, a remarkable number for a massive economy like that. But the comment, I think, Neal, that you made is that, the Chinese are looking for more consumption-led growth rather than, infrastructure-led growth. And that would impact, on the kind of demand that there would be for commodities going forward. Would you mind just commenting a little bit more on that and what that impact would be on the demand for commodities, and what you see, that being?
Yeah. So China has announced, they sort of didn't announce. So that China's always had sort of growth targets, and they actually did stop doing that last year, but they did announce one recently. So they've now said that they want the Chinese economy to grow by over 6% this year, right? And that's a done deal because it was like weak last year. 8% is kind of pretty much a low number, right? So it could be well above that kind of figure. I think going forward, I mean, my sort of modeling of the economy has growth slowing to kind of more like 3 to 4% by the end of this decade in China. And that's just a function of convergence of the economy. As it gets richer, as you get richer, growth slows naturally, right? Because you've got less productivity gains to sort of make up. So China's economy, you know, will slow. In terms of metals demand, you know, our steel team, they're pretty much got steel output in China peaking now in the next 3 years. So it's kind of levels off. So we don't see steel demand in China growing anymore. Now, you know, I mean, I guess maybe they could export more steel and that might boost some growth. So I think, you know, and elsewhere, so stainless is going up because that's more about consumer goods. But I think we are talking about a you know, it's been happening for a while, but I think we are sort of saying now actually China is sort of reached, potentially it's kind of, it has got to kind of peak steel, right? And that still happens earlier, but, you know, 10 years after steel, you get kind of peak copper and everything else. But, you know, within that, you know, EVs will have a different dynamic for those markets. And also you've got other parts of the world picking up as well. So you know, we used to talk about India quite a lot. I mean, we sort of gave up to India, but, you know, India is growing, you know, and consuming more kind of metals. Parts of Asia are as well. So global growth will continue, you know, across the board at varying rates, but it's not going to be supercharged in the same way. And I think one of the things that you know, there's been a lot of talk about super cycles recently, and I guess super cycles, I guess, you know, sort of define what they are, but you know, super cycles are typically where you get a period of sort of a decade of elevated prices, rather than the business cycle where you get kind of 3 to 5 year business cycles. I guess when we had the last super cycle, and I lived through that and enjoy the fruits of that and the challenges of that was, I mean, that were driven by two things. One was sort of a step change in demand growth, and the other was sort of lack of investment, or investment really had got behind the curve. And whilst demand took off, supply couldn't adjust quickly enough, and that led to that kind of that 10-year cycle with a kind of hiatus during the financial crisis. I guess now, you know, arguably, I would say mining supply has been constrained for the last 5 years, except for lithium, and that was really a function of the last downturn, and people said we got it wrong, and we sort of going to have conservative balance sheets and be more rigorous about our investment criteria. So supply is sort of lagging, I think, in a lot of markets. But in terms of demand, we haven't really got that same China story now in terms of step change in demand growth. So in terms of the super cycle thing, I don't know we have both sides of that balance in place. But you know, that said, you know, mining's always hard and declining grades, and you know, that might be sufficient to keep prices up for a period of time. But I don't know we have that super cycle, you know, thesis, to my mind, you know, in general happening. But I know in Roskilde there are different views on that. I know John's very positive on the copper, for example, for its particular sort of underlying reasons in that particular market. So again, it's differentiating between each commodity. But I would say China story still is probably less good than other parts of the sort of mining industry.
Yeah, to talk specifically on copper, I mean, we've talked to a lot of people in the industry over the first quarter of this year, and I'd really say the jury is very much out. I think, you know, if I was to summarize it, I'd say a third of the people think, yes, we are on the dawn of a new super cycle in copper. A third of whom would equally say, no, we're not. And the other third would say, we honestly don't know. So it really is quite a divided picture in copper. But certainly I agree with Neal that the supply side is very challenging, and we've seen 5 or 6 mine disruptions already this year, which cumulatively will be quite significant. And on the demand side, there is some optimism in China. Obviously, in the first quarter, you're comparing it against the pandemic period, so the comparisons are very extreme. But what we've already seen is round about a 22% increase in a year-on-year increase in output of copper semi-manufacturers in the first 2 months of the year. So that's a broad indication of copper demand. But some individual subsectors are doing extremely well. Neal also mentioned EVs. Sales of EVs in China first 2 months of this year, or sorry, production of EVs in China first 2 months of this year increased by 390%. Last year, the real strongest sector of copper demand in China was investment in electricity generation. Power generation expenditure grew by over 50% last year, and when you're comparing that against GDP growth of 2.3%, you know, it's almost 20 times as big. And almost half of that investment was in wind power, which actually grew by 110%. So something about wind power is very copper intensive, 3 to 5 times more copper in a wind farm than in a conventional power station per megawatt. So you have some micro sectors of the Chinese economy that are very copper intensive, that are growing very quickly. I think even last year, you know, the copper industry itself is a bit divided on how fast Chinese demand grew. We think it's at least 4 to 5%, so twice as fast as GDP. One of the reasons why it's more complicated is it's clear that the Chinese SRB was buying copper for its stockpiles. The extent of these purchases are unknown. And equally, there was a shortage of scrap in China, so there was additional metal flowing in to replace missing units of scrap. So the copper story is complex, but certainly I think looking forward for this year, you know, there is likely to be continued growth, not at the same pace as last year probably, but some of the areas that weren't at the party last year, such as air conditioning, winding wire, and connector strip, are actually performing very strongly in the first 2 months of this year. And a lot of these Chinese fabricators that have been shut down on holiday for the Lunar New Year are now starting to come back. So it'll be interesting to see as we get the data through for March, to what degree we see a continued improvement in Chinese copper demand. I absolutely agree with Neal that peak copper in China is really still a decade off. The reason for that is that the real reason you're using copper is overwhelmingly for its electrical conductivity, and electricity demand per capita in China is really still only at 40% of the peak that we saw in Japan or Korea when they reached their heights. So the copper story in China is a positive one, and still that has another decade out to play.
Thank you.
Yeah, thank you.
Andres, you said that you had something you wanted to say or ask?
Yeah, but I first think Michael in the chat window did ask a question. So maybe, and he preempts me, so maybe we should just...
Mark, are you able to ask the question or not?
Hi, yeah, sorry, I just asked the question because I had a noise in the background.
Okay, that's why I was asking, thanks.
Yeah, thanks. So it's really just around regionalization of supply chains. You've seen a lot of auto manufacturers outside China looking to secure supply, build factories, and obviously just from an ESG point of view, to shorten their supply chains. How do you guys see that impacting sort of mining and exploration in Europe and the rest of the world?
Well, I mean, it's certainly that is the dominant trend, as you set out. I think OEMs, particularly in the automotive space, are desperate to have local, sustainable supply chains for, particularly for batteries. I suppose batteries are the poster child of this new energy area at the moment. Now, whether that's a possibility or a reality is another question. And ultimately, the scale of new demand for lithium, cobalt, nickel is really, really considerable. And you're not going to source all of that from places outside of China. Lithium ultimately, in terms of feedstock, comes from Latin America and Australia, and China is mainly processed in China. Cobalt, mainly 65% from the Democratic Republic of the Congo. That is pretty much all exported to China, which is similarly accounting for about 60 to 70% of refined cobalt production. Nickel also maybe a bit more broadly spread in terms of its mine production, but certainly the production of nickel sulfate is a China story as well. So it's perhaps a little bit of a fantasy at the moment, at least for Western OEMs, to hope that they're going to be sourcing the lithium, cobalt, and nickel units locally. Ultimately, China's always going to be, or at least for the next decade at least, a significant part of that story. But it does present opportunities for non-Chinese or local mining projects, refinery projects to bring themselves into production, sort of supported by this narrative that there really is a desire for local, more sustainable sourcing. So perhaps for the first time, it's not just going to be economics, but it's going to be sustainability, CO2 intensity, geography that's really going to have more of a deciding factor in whether some projects get developed, come to fruition, start producing these raw material units.
I think the other thing here is also the kind of role of government. And, you know, I mean, people are concerned about rare earths and supply security. So, you know, to what degree can government influence investments? So both mine investment and also downstream processing. So government see it as a sort of a risk or an opportunity in terms of developing businesses and sort of, you know, so if it's Western Australia or parts of Canada. So I guess how does government help and support that development? Working in partnership with sort of private industry is sort of not quite clear. So they have very kind of high level objectives, but in terms of sort of, you know, beyond sort of some research budgets, are they really going to provide the sort of support by, if it's tax support or permitting approvals, how does government help that kind of picture play out as well? I think that's something that sort of is really sort of interesting part of the discussion at the moment.
Yeah, for copper in China, I mean, China is aiming to have its automotive supply chain really totally domestic in origin. There's a lot of investment now in copper foil, electrodeposited copper foil for the batteries. At the last count, there were over 20 new projects, either expansions or brand new foil mills in construction. So China really views this segment as something which is sort of red hot in terms of demand currently, and a lot of players are seeking to jump into that sector with very aggressive capacity expansions.
Great, thanks. Anybody else who would like to ask questions?
I suppose I think Michael pretty much asked, or the response to Michael pretty much answered my main question, but I have another one, I suppose a little bit more topical at the moment. What do you think of for instance, events such as, you know, the Suez Canal being blocked at the moment? Are we expecting to see any form of response in the market to something like that? Is it big enough to actually have a real impact, or is it just, you know, a kind of a hiccup? I mean, we're talking apparently weeks for unblockage. I don't know.
Well, I think for metals, not so much. I mean, it's clearly impacted the sort of freight markets. So freight rates have gone up. The oil prices responded as well, although not kind of too much. I think it's probably seen as a sort of short-term event, but it does highlight sort of supply risk issues in the sort of, you know, commodities area, right? So that narrative of supply security sort of comes into play. But I don't know, the oil price did move, but it's not kind of been a transforming effect on it. And for most metals, I'm not sure there's a lot of trade through. Yeah, it's really going to sort of disrupt those markets in the near term. But I'm not a trader, so someone somewhere is kind of working out the angle and trying to make some money out of it.
So basically, just a hiccup.
Yeah, I mean, unless John or Jack have heard anything in terms of, you know, markets that they're aware of.
I don't know about really the specifics of particularly metals and minerals passing through, but I mean, it's not unrealistic to think that there could be an impact. I think delays in shipments and freight costs and other things have pushed the prices of certain materials up as a result of disruptions in China this year. I mentioned earlier the disruption to flows of copper and cobalt coming out of the Congo when there were issues related to infrastructure and transport in South Africa last year. So any sort of short-term infrastructural hiccup could have a bit of a wider effect on commodity prices. I'm just not exactly sure which, if any, are particularly passing through the Suez or not passing through the Suez at the moment, and therefore there might be a price reaction from that.
I think for copper, it's just really a temporary dislocation. I can't really see it having any significant lasting impact.
Happy, Andres?
Yeah.
Okay. Anybody else?
Maybe just one more from me. You haven't said too much about the platinum group metals other than rhenium. And of course, in South Africa, we're being sold the idea that this space has a pretty bright future. Do you have any views on that?
Well, I mean, it's gone. I mean, iridium's gone crazy, right? So, yeah. I mean, we have done some work on PGMs in the past. I've in a previous life done some work on PGMs. I mean, I think I think there. I mean, clearly the sort of the transition to away from sort of diesel and petrol vehicles to EVs is sort of a negative effect in terms of palladium in particular. On the other hand, there is some hope for kind of platinum around obviously fuel cell vehicles. I think they're kind of longer term plays out there. I think it's interesting. I mean, you as a PGM producer in South Africa, you now get more for kind of rhodium than you do for kind of platinum, right? So they're not kind of they're kind of palladium and rhodium producers rather than platinum producers, aren't they? So, but that's part of the basket story. So I mean, last work we did was sort of really suggesting that tightness in the sort of in parts of the PGM market will dissipate over time as sort of demand adjusts, and platinum might be the offset to that longer term. But I don't we don't have sort of regular sort of supply demand platinum forecasts. But I mean, Jack, you sound like you have some sort of
I absolutely do not have a different opinion. But what I would say is that Neal started his slide deck by plugging our local conference in Johannesburg, and we do intend to have a PGM aspect to that event and look at the outlook for the local supply chain in detail. So we'll form more thoughts between now and next February for sure.
The only thing I can add is that catalytic converter theft is at extremely high levels in the UK and probably everywhere else.
Thanks.
It's got to be great for replacement demand.
Thanks. I need to run. Craig, could you just carry on with this, please?
Okay. Thanks, Nolene.
Thanks so much. Thanks, guys. Bye.
Are there any more questions or comments from anyone in the audience? If not, I'd like to thank our Neal and our Roscoe visitors. And I guess I'm not sure of exactly the dates, but this series will carry on. I think it's quite useful in terms of what's facing us down the road. We're not through this COVID pandemic yet. And I think the future is a little bit more uncertain than it has been in recent years, but hopefully we'll work our way through it. And gentlemen, thank you for your advice and your presentation. With that, I'll sign off and we'll see you again at the next lecture. Thank you very much.
Thank you.
Thank you.
Yeah, my pleasure.